Hey everyone, me Kevin here. In this video, I'm going to react to another Kevin O'Leary, who shared some of his money advice with fellow YouTuber Graham Stephan.
That was unfortunately a cash deal. The whole thing was a cash deal.
You couldn't get credit at that time?
Right, I didn't have a credit card.
Right.
So no bank wanted to give a 21-year-old a loan because I had no credit history.
Okay, so right there is an important lesson, and I tell every millennial, even though I don't endorse credit cards, it's very hard to advance your credit rating without having one. So it's good to get a credit card, put maybe a $1,000 limit on it, and then start paying off, use $200 a month, and pay it off every month.
That is extremely great advice, and something that I did when I moved to California to move in with my girlfriend, now wife Lauren, was as soon as I turned 18, I went to Wells Fargo, the only bank who was willing to give me an unsecured credit card, and I got my first credit card. And I would just buy little packs of gum or little things. I paid that thing off like 3 or 4 times a month just to do whatever I could to make sure I had no debt on my credit card. He mentioned get a card, put $50 to $200 on it every month, pay it off every month, and cap your limit at $1,000. This is actually very good advice because it prevents you from making large and sudden purchases on your card and then kind of getting sucked into the debt trap.
But you got to admit, you've benefited from the appreciation of this one asset class, real estate, as interest rates went down.
Correct.
So there is an inherent risk of concentration here. Your entire net worth is only in real estate so far.
Yep.
Kevin O'Leary is 100% right on when he says, hey, you've benefited from interest rates going down. And that's so true. Yesterday I made a video saying if you want to keep an eye on when the market's really going to crash in real estate, here are the things to pay attention to. And in that video, I explain the rule of 1 and 10 in real estate, which means for every 1% that interest rates go down, real estate prices go up by 10%. It's incredible how quickly and real that is consistently. So keep an eye on that. But let's talk about the concentration aspect that Kevin O'Leary just brought up. We'll see a bit more of this later in the video, but Kevin O'Leary really recommends diversifying and not having everything concentrated in one spot. This is where I disagree with Kevin O'Leary, and it depends on which phase of life you're in. Let me try to explain that. Sometimes I hear people say, Kevin, I've got $10,000 saved up and I'm so diversified. I've got $1,500 in gold, $1,500 in cash, $2,000 in bonds, $2,500 in stocks, and $2,500 in some real estate fund. And I'm thinking to myself, that's great. It's very well diversified. If one of those asset classes goes away, no problem. You still have a ton of your money left over. But I differ here. When you're early in life and your net worth is $10,000, I would take a completely different approach than what Kevin O'Leary is recommending. I would rather see taking that $10,000 and purposefully doing what Graham did and concentrating it into real estate, whatever amount of money it is. For example, when I bought my first house, I put $10,000 into a house and turned that into an over 6-figure amount by buying a property below market value, fixing it up. In fact, you can watch the entire video where I explain this. It's called How I Turned $10,000 into $200,000 in 90 days. That's the biggest boost to my net worth almost instantly. When you first start out with a very low net worth, you're in what I call the building fork of life. Your goal, in my opinion, is get off the ground floor, concentrate your investments into where you know you can make a lot of money, build wealth. Then, once you reach a certain net worth, whether that's $200,000, $500,000, or $1 million, or whatever number that you feel comfortable with, then it makes sense to start protecting the base. But when you have $0, it doesn't make sense to try to protect the base because you don't really have anything to protect. Protecting the base is when you actually get off this ride of trying to build your wealth like crazy and you start paying off debt and you start trying to minimize the things that could potentially create risk in your life. Paying off real estate, paying off a margin on stocks, whatever creates risk in your business, you start paying that off and you protect the base. This again, it takes you off that growth fork for a bit, but that's okay. In the future, you can always hop back on to the building wealth phase. But taking these little pauses to protect the base is extremely important because sometimes what happens is if you stay on this building phase where you always concentrate your investments and you never protect the base, then what happens is you keep taking risk on risk on risk on risk on risk, and then if things go bad, all of it crumbles and you end back up at the starting line. It's kind of like you're playing Monopoly and it's like, go back to the beginning. You just lost everything. And that sucks. Protecting the base means if you start taking off again here, you protect the base, you pay off your debts, you have nice passive income that comes in, then you decide, okay, now I'm gonna build my wealth again. You go back on the building wealth phase. You fall back, if worst case you fall back, you never fall back to a point that's lower than that base you protected. In this case, that $1 million net worth number.
Great analogy. I met a very, very wealthy real estate developer in New York that came over with nothing from Europe when he was young, when he was 18 years old. He's a multi-billionaire now. And each time he bought a building, he did apartments. He would call it either a pasta or a protein building. And I said, what does that mean? He said, well, I start with my first building and I would take a lot of debt down and I would get the rent roll up so I was 100% leased out. And I would only eat pasta until I paid off all the debt. I said, really? He said, yeah, because it was just my wife and I, and we had all this mortgage on that building, and I know what happens during cycles. And so once they paid off that building and now all the cash flow was coming out of the building with no debt on it, he'd start to eat steak. It became a protein building. And his whole life was always making sure that he had enough buildings with no debt on it to sustain the downturns, because the New York in those days every 7 years would take a dive of 30%. So what he would do is he'd always have a couple of protein buildings spinning cash. When the correction hit, he'd use that cash flow to buy new buildings. But he never went bankrupt because he never extended himself so far that the protein buildings couldn't pay off the mortgages, of the pasta building.
So this is him buying that building. He's doing that sprint, right? That's the concentrated wealth building period of his life where it's like, oh man, I got a big mortgage. I know there's gonna be another real estate correction at some point in the future because real estate is cyclical. It will go down at some point. All right, I got a new building. Let me now go pasta mode and do whatever I can to limit my risk. That's the payoff phase. Notice that? That's the pasta phase, the payoff phase. And then as soon as he got that building paid off, he went back, okay, now we're ready to do a sprint again. Because like Kevin O'Leary said, if the poo-poo hits the fan, in this individual's example, if the poo-poo hit the fan while he's on the sprint, he wouldn't necessarily fall back to zero. He'd fall back to where he last built his base, his support. You can think of that baseball field. It's on second base. Go back to be safe. And because the person took his effort to protect his base, his additional cash flow from his prior deals actually enabled him to go shopping when these back sets would happen or these crashes would come. So he didn't actually even get pushed back. Instead, he had assets that he could use to actually accelerate his wealth at a faster pace because he took a break, protected the base, and made sure he had extra assets available in the event the market turned. This is something that happened to me during the pandemic. Before the pandemic, I was extremely anti-refinancing real estate. I had properties that I've owned for 7-6 years that I hadn't refinanced, and they had built up a lot of equity. As soon as the pandemic hit, right around March 6th, March 7th, the Federal Reserve freaked out. I called up my lender and I said, break the glass. Let's refinance 4 to 8 buildings. I used that cash that I had ready going into a crisis because I knew if we were going into the crisis, any kind of crisis, cash would be king. And so when I had that cash and we hit market bottom around the end of March, early April, I started buying stocks like crazy. And so that's an example of protecting the base, is not constantly refinancing and taking on debt on top of debt on top of debt to where you're overextending yourself. It's nice to have what I call a little piggy bank that you can break and haha, I got all this cash that I can now work with and take advantage of opportunities. Very similar story, very, very smart.
All of these, by the way, are rented under market value.
I get it, but how long are the leases for?
1 year.
And so do you get to bump it up?
I don't raise rents, believe it or not.
What?
Yeah.
Really? Why not?
My thought is if I have a really good tenant who always pays on time and no issues, I would rather just not raise the rent and keep them there a long time. And if they do move out, then it's kind of like gravy to me because I'm able to rent it out for even more to the next tenant and then tell them they could stay there as long as they want at that price.
Yeah.
And for me, I've had some tenants now for 7 or 8 years.
Now here's something that I have to beat Graham up on. Graham lives in California, which is a state that has statewide rent control. And this even applies for properties that do not have rent control. But it's even worse in areas with rent control, particularly in areas like Los Angeles County, which have even more strict rent control laws than the statewide rent control. Here's what happens. When you don't raise rents on tenants, tenants end up falling behind on market rents. Now, Graham said he rents his properties below market value. I do that as well. If market value is, say, $2,800 for a unit, I might rent it for $2,725 or $2,750 because it gives me a choice of the highest quality tenant. I have more competition when the price is low, and then I get to pick the tenant I want. This makes sense, but rents should trickle up, even if it's just a little bit. Here's a $30 rent increase. Here's a $40 rent increase. I'm not talking about the stupid bait and switches that the big apartment buildings do where they get you in at $2,700 and then they give you a $200 rent increase because they're betting on you not wanting to move. That's a scam. Like, that's just mean and wrong. I'm just talking about a 1.5% rent increase every year, so that way you keep pace with inflation. Because here's what happens if you don't. Let's say you own a duplex and you don't raise the rent for 10 years. Rent control makes it almost impossible for you to now sell the property for market value. See, my real estate investing course, linked down below with the coupon code down there, I explain the value of multifamily real estate is in the rent you get. In rent control areas, the problem is even worse because you can't just tell a tenant to move and put a new tenant in at a higher rent and then sell the property. You're stuck with the tenant unless you want to negotiate a big fat buyout with them. In my county, I have to pay 1 month's rent to get a tenant out, and then I can have a new tenant at a higher rent. In Los Angeles County, though, in lots of cities, a tenant can negotiate that amount with you. That means a tenant could demand $20,000, $40,000, $50,000, $80,000 to move as sort of a relocation expense because they've locked in this low rent for a decade or 7 years or 15 years. And so not raising the rents actually severely hurts the market value of your property and makes it harder to sell the property and makes it harder to get the tenant out if you needed to, which means you actually create more risk, you have less liquidity in your real estate, and you're in a very dangerous situation.
Because I'm older than you, I've seen a lot of things, and I've been through a lot of down cycles. Lots of my friends got wiped out. Mm-hmm. I mean, imagine being in your 40s and being wiped out, having to go bankrupt. Mm-hmm. Like, that changes your life forever because you have that on your back. I would never want to wish that on anybody because it is a horrible thing to happen. And the only reason it happened to them is they didn't respect debt. You're being disciplined. You're buying assets that have income. They were buying boats and cars and watches and getting divorced. They loved their lifestyle. Yeah. They went to zero. You have to respect that, and you do. This makes sense to me, but again, I go back to that guy in New York, protein building, pasta building, and the whole idea of respecting how debt can rip your life apart.
So true. One, Kevin O'Leary tells us something that I talk a lot about in my money course, my real estate course, and that's the difference between guns and butter. When you're on the building wealth phase of life, your goal is to actually postpone buying watches and art and boats and big houses. In fact, Lauren and I get asked regularly, hey, Kevin and Lauren, how come it is that if you own all this real estate, you don't have a bigger house? Why aren't you spending on bigger things? And that's because we love this pasta protein analogy, where it's like, hey, we'll build wealth, we'll buy some good deals in real estate, but you know what? We're not gonna go crazy and ham and go and buy in real estate in this insane way and over leverage everything. We're gonna take a pause, and we're just not going to refinance for a bit. And we did that for years, and we kept a pause. And so that way, when the pandemic came, we were ready to do it. And now, starting in July, I've started doing the same thing again. In July, I've mentioned, I'm not ready to go crazy anymore, for example, in stocks. We're going to pay off and protect that base again. In the meantime, we're also not spending big on a big new house, on watches, on boats, and things like that, because we're so focused on just investable assets. It's a great way to go because in the future, once we get to this point where we say, you know what, just pay everything off or sell everything and throw it all into AT&T, take my 7.5% dividend and just coast, we can do that. We'll have a very nice number to do that with.
Clearly, real estate still remains more than 20% of your net worth. Mm-hmm. One of your goals should be over time is to make it to get such a broad portfolio in your net worth that real estate's only 20%. So if that asset class really has a hard time, it can't take you out of business.
Got it.
So right. Over time, though, the qualifier got missed a lot. I got so many questions. People are like, Kevin, you have way more than 20% in real estate. So does Graham. So true. But he is correct. Over time, you start paying down, then you diversify on the protect the base phase. But while you're building your wealth, it's okay to concentrate. In a safe way, of course.
Let's look at this. Stock market investments. Individual stocks, 1.14 million. Index funds, that's good, 772,000. California state free bonds, very good, 150,000. Silver, 12,000. Acorns, so you're using Acorn, that's good.
Yeah, I tested all the apps so I could give it a shot.
Yeah, that's fine. Okay. Cash, 320.
That's within the stock market brokerage.
Yeah.
It's not all cash, just so I continually buy into the market.
The discipline is every 90 days to trim back anything over 5% and put it into something else that you've decided to go into. What happens to portfolios like this that aren't, it's like trimming a hedge. No sector more than 20%, no stock more than 5%. You've got 3 stocks here over 5. You give up some of the upside, but when the correction hits, like a Tesla rolls over and goes down 38%, you don't take the full hit because you've taken profit out on the trimming.
I'm worried about taxes.
Yeah,
because my thought is 50%.
Yeah. And I'm telling you, that's the biggest mistake you can make in your life is to worry about taxes. The fact that you have to worry about taxes is a wonderful thing. It means you're making money. But to say, oh, I don't want to sell, a stock that's now 11% of my portfolio because I don't want to take the tax hit, you will pay a brutal price for that. You will have a massive correction, you won't have taken any gains, and you will have hurt yourself immensely. That's the one mistake you're making here. So you've got to do your work.
Here. All right, first, the 20 and 5 rule. 20%, no more than 20% of your money in one asset class and no more than 5% in one stock. This again, perfect when you're in that payoff phase of life. If I said, all right, we've hit a net worth goal, it's time to retire and it's time to diversify, this is perfect advice. And so this is something that a lot of people have mentioned, oh my gosh, Kevin, it's like as if he's talking to you because of Tesla. But in my live streams every morning, when I talk to my course members about my stock strategy, I invested in Tesla heavily going up through around July. A lot of my purchases were right between 700 to 900, and these are pre-split figures. When Tesla started hitting anything above 1,500, I said, I'm not going to buy heavily anymore. I think it's a little too expensive. And the stock split was coming, and on my channel you'll see videos, a warning about the stock split, a note about the Tesla stock split. I've mentioned many videos that I think this is going to be hyped up and it's going to come crashing down. I won't buy Tesla individually until after that happens. And so we hear this 38% speculative in this crash, and this sounds so painful, but all of my exposure was mostly right before that. Now, that example there is by no means to say that you should go all in on Tesla. I do think that would be a mistake. I would probably divide my portfolio out like this: 25% Tesla, 20% other stocks, and then 55% real estate. Not very diversified, but I'm also on that growth phase. That growth phase where I'm trying to do what I can to buy value and insulate from that any kind of downside risk. And then in the future, when we decide, all right, time for payoff mode, then we can split it all up using that 25 method. It's not bad advice, but for the growth phase, I disagree with it. Kevin O'Leary talks about taxes. Hey, if you're making money, tough problem to have, pay your taxes. I disagree with that in the growth phase. If we get to that phase where it's payoff mode time, let's diversify, and I start purposefully making less income because maybe I retire, hey, then at that point, I don't have to pay high taxes anyway because my income's not going to be as high. Then let's slowly start offloading, pay some of the taxes at a much lower tax rate.
Are you using any margin?
No.
That's the other thing. Never use margin in stocks. Never do that. Never. Never, never, never. People think margin's free. When there's a correction, you get slaughtered.
Right.
So right. He's absolutely right. Margin is so dangerous, and I think margin is evil. In fact, I just made a video about how I used margin and found, this is evil. And I highly recommend you watch that video because it'll teach you a lot about the psychology of margin and debt on stocks, which is so much worse than debt on real estate. Well, there you have it. There are my responses to some of the big things that were in this video. If you've enjoyed this, check out the programs down below for much more perspective. And folks, we'll see you next time.